Now, we have a team of people at Bloomberg News that have been digging through these documents. Bob Ivry of that team will join us with the latest. We'll dig him out of those 29,000 pages of documents right after the bell. And right now, I'm going to pose a question about that, or a few, to Tony Crescenzi. He's Executive Vice President and Portfolio Manager at Pimco, which runs the world's largest mutual fund. Let me ask you, Tony, about this, because you have said that it may hurt the borrowers, or it may hurt people whose names come out when we get this data.
Well, we don't want current information on this sort of thing. It's one of the reasons why the FDIC, in its trouble list that it puts out quarterly, doesn't list the names of the banks. I'm reminded of George Bailey and the Bailey Savings and Loan in the movie It's a Wonderful Life, and the run on the bank that took place just because people got nervous. And so you don't want to instill nervousness where perhaps it's not required, because as Mike said, perhaps it's just the daily ins and outs of money flow that causes a bank to go to the Federal Reserve, and perhaps it's not a solvency issue and just a liquidity issue. And so we don't want to create undue concern amongst healthy banks, and that's possible if the information is too current and if it's put in the wrong context.
So, is that confidentiality at odds with the goal of transparency, which Ben Bernanke has set as a goal? A lot of Fed watchers have said it's very important for central banks today to be transparent.
Well, here's a case where human nature and the tendency toward nervousness in times of crisis need be kept in mind with respect to policymaking, because the regulations are good, and it's great to have this sort of transparency, but not at a time of crisis and nervousness and anxiety where the human element comes into play a great deal and can cause runs on banks, even if there aren't deep problems in those banks. Because banks by nature are levered, because they, of course, are lending out more money than they're taking in. They have just 10 cents has to be put aside in every dollar.
How do you see, though, the health right now of the financial industry?
Much better, of course. You can look at the capital to asset ratio for banks, and it's at all-time highs, at 11.5% or so, up several points from the worst point. And of course, banks are being told keep stronger balance sheets, and they're not lending much. They are buying more securities, and securities make up about 20% of the $12 trillion in bank assets now. And they're being very careful about the types of loans they make. So even though they're easing lending standards, they're still requiring very high standards, generally speaking, to make loans, and they're going to be very careful. And the loan losses are starting to decrease, and delinquencies and that sort of thing. So much healthier, of course, but a couple of years to go or so probably in the deleveraging process, at least.
Welcome back to Street Smart. Yesterday on the show here, we asked Mark Faber, publisher of the Gloom, Boom, and Doom report, about U.S. Treasuries. Here's what he had to say.
I think long-term U.S. government bonds are undesirable unless it is for a rally, maybe in the next 1 or 2 months if stocks sell off.
So shockingly understated for Mark Faber. Treasuries are falling now, anticipating a relatively strong jobs report tomorrow. We're back here with Tony Crescenzi from Pimco. Your boss also has come out, I don't want to say against U.S. Treasuries, but he doesn't want to hold them right now. Is everybody going to get on that side of this trade? Because it seems like yields are staying relatively low.
Well, there is a natural demand for treasuries by many entities, so not everyone will get out. Half of treasuries are held by foreign entities, and they're still accumulating what are known as international reserves. There are 9.5 trillion of these. So Brazil and Russia and Japan even, and China, of course, are continuing to build reserves because they're taking in more dollars than they're letting out. And they are wanting to put these dollars, of course, in treasuries, a decreasing proportion of them, of course. It is declining the dollar as a reserve asset from 70% in 2002 to 63% of world assets now. But reserve assets are still accumulating because of the strength of the global economy. So there'll be a natural buyer from the biggest buyer, foreigners, but at a decreasing level. Pension funds and insurance companies also buy. But I think what your main point is, are people less interested in treasuries now, and why? And yes, we are less interested now because they represent pure interest rate risk, which is to say they're very tied to the inflation rate and the Fed funds rate. Now, the Fed funds rate is not likely to rise this year. That's the rate the Fed controls. But the inflation rate is rising throughout the world. Today, Europe reporting a higher inflation rate again, of course, and one reason why the European Central Bank will be raising interest rates. And so being tied to pure interest rate risk rather than having some credit risk is not the way to position in portfolios this year. So the simple line is, prefer for bond investors, they should be preferring credit risk over duration risk this year, which is to say own company bonds, et cetera, not treasury securities. Eliminate that interest rate or reduce the interest rate related risks in your portfolio.
Let me ask you about inflation. I have your note here from the Pimco website. It starts off, inflation is a ravaging pestilence so viral that when let in, it can erode the quality of life substantially enough to alter the course of history within smitten nations. It's a great read. It goes on, and it's very dramatic. I mean, should we all see food prices rising, we all see gasoline prices rising, but core inflation still 1.1%. Should we be that concerned?
Well, the article on our website, that interesting line I wrote in an article called Strategos to talk about the Federal Reserve and how it must shift the battlefields now. Of course, the Federal Reserve, and strategos is a word for a Greek politician in 500 BC who was both, a Greek official who was both a politician and a general. You could say about the Federal Reserve officials, they are both politicians and generals in the sense that when they cater to one side of the dual mandate and try to promote employment, they are politicians. When they cater to the other side and try to fight and battle inflation, they are generals. Now, it's time to shift, perhaps increasingly, as the expansion moves on, recovery moves on, from being politicians to generals. It seems the Fed need be concerned with what the public is concerned about, inflation. Now, there is no, as you said, direct correlation between headline inflation, which is 2.1% year over year in the United States, using the Consumer Price Index as a guide, versus the core price index, which excludes food and energy. That's at 1.1%. There isn't very good correlation. In other words, core inflation is the better gauge to follow, but the public doesn't fully get that point, and they are concerned about food and energy prices and believe that the Federal Reserve and its accommodative policies are having influence.
I see. So the first line of battle for these generals is to fight inflation expectations, not to raise rates. They need to use, I think you say, permanent open mouth operations.
Open mouth operations, which is a way of saying something different than open market operations, which is something the Fed does on a daily basis.
But this is why they'll start with more and more press conferences.
This is why you're seeing words and press conferences to try to make it the first line of defense against inflation expectations, to quell concerns that the $1 trillion the Fed has put in the system might spark inflation. Now, when inflation expectations pick up, it tends to feed into wage demand somewhat, more so in emerging markets where food and energy are bigger parts of daily living. But it can permeate to some extent here, but not a great extent, especially given an 8.9% unemployment rate. We shouldn't expect meaningful wage gains and meaningful inflation from here.
Welcome back to Street Smart. Financial markets waiting anxiously, as usual, for the jobs report tomorrow. Back with us is Tony Crescenzi of Pimco to discuss the potential impact of that report on the bond market. So what do you expect? I mean, it hasn't been looking that bad lately. We've been adding jobs for 4 months in a row. We'll probably add jobs again tomorrow?
Highly probable. I mean, 5 out of 7 weeks, jobless claims below a critical number of 400,000. That tends to indicate acceleration in job growth. All the manufacturing surveys, the regional and national manufacturing surveys, seem to indicate better employment conditions. It seems highly likely that job growth is exceeding labor force growth now, and that will continue the move downward in the jobless rate. But let's not misunderstand the quickness of the progress. It took 4 years after the last recession to gain all the jobs back that were lost. It'll probably take at least 5 or 6 this time because the magnitude of losses was greater and more of it was structural this time than it was the last time. In other words, areas like construction and retail and automobiles, they're not seeing levels of activity high enough to support the former levels of job growth, job employment, and they're not likely to anytime soon. For example, in the construction trade, 2 million jobs were lost. Housing starts today are 500,000. They were once 2 million. Can we imagine those 2 million jobs coming back anytime soon? No. And so, yes, gradual employment. And for an investment thesis for this, it's to expect GDP growth of 3.5% nationally, 4.5% globally. It's good enough for riskier assets and not a reason to be in Treasuries, because in this environment, those assets do better.
Let me ask you then, if you were to fly back to Pimco's offices in Newport Beach and stop in flyover land, right, and talk to somebody on Main Street in Middle America, say Ohio, and he said, Tony, I'm going to give you my money at Pimco. Where are you putting it right now? How do you explain it to him? I mean, credit risk sounds kind of jargony. Where do you want to put people's money right now?
Company bonds. I mean, they may know and understand many companies they're interested in. Perhaps, depends on the age of the individual, perhaps they'd like to be higher in the so-called capital structure. There's some jargon for you, but that's another way of saying bonds are less risky than stocks. So perhaps they're not as interested in diving back into the stock market in the way that they played in 2000 or even before the financial crisis began in 2007. Perhaps they'd rather be higher in the capital structure and be in the less risky asset, which is the bond, because the company bond, the corporate bond, of course, the holder is first in line in the event of a problem. And so there are many individuals like that, because remember, $15 trillion out of $65 trillion of household wealth was lost in the financial crisis. $6 trillion has been regained. So households have a very big interest in trying to regain the wealth they lost and preserve the wealth they have. And this, in many cases, will mean owning bonds rather than owning risky assets, not just stocks, but commodities and real estate, and perhaps even places investing in the real economy.
All right. Hey, Tony, it's a pleasure to spend some time with you. Thanks so much for stopping by while you're in New York. Tony Crescenzi, formerly of New York, Staten Island, now out in Newport Beach in California with Pimco.